4 tips for selling in a down market. When markets take a dive, the last thing you want to do is sell at depressed prices, but sometimes you have no choice. A medical or tax bill could be due, or you may simply need to replenish your cash reserves. Whatever the reason, there are ways for cash-strapped investors to minimize the impact on both their portfolios and their long-term investment goals. Experts say it's important to make strategic decisions rather than emotional ones because if you don't, you might end up locking in losses and could run the risk of permanently undermining your portfolio's ability to recover. With that in mind, here are 4 strategies for selling in a down market. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about 4 tips for selling in a down market. Every now and then the stock market is known to go through a tumult. And recently with the coronavirus, the COVID-19 pandemic, we have seen sell-off in the markets. People were a little acting irrationally, and I just want to give you a few tips here for the next down market, how to react. And if you want to sell, then you have to be methodical in how you sell and how you can be able to rebalance and have in the end a nice ROI despite the temporary tumult. First thing you need to do is to rebalance your portfolio. Periodically rebalancing your portfolio, which involves selling overweight positions and buying underweight ones to keep your portfolio in line with its target asset allocation, is always a great idea in the best of times. But when the going gets tough, it can also be a great opportunity to help you make dispassionate decisions that can lead to better outcomes. This is the important things here. Dispassionate. We want to be very rational and make those decisions objectively. So rebalancing is the key. You can do the rebalancing every 3 months, every 6 months, depending upon how the market evolves. So if you see a position that has moved from underweight to overweight, you sell it. And those that have if you see a stock that has lost a lot of value and therefore has become underweight, then you buy more. The recent market turbulence likely threw your portfolio out of whack. So by refocusing on bringing your portfolio, for instance, back to its target allocation, you can very easily identify those assets you would probably want to sell anyway. Let's just walk into a very simple, practical example. Imagine you had a 500,000, $500,000 portfolio and a target allocation of 60% stocks, 35% bonds, and 5% cash investments. So 60, 35, 5. That's just a reasonable allocation, and for someone in his 20s, in his or her 20s, all the way to 40s, late 40s. So after a rough few months, let's say 3 or 6 months, the stock portion of your portfolio falls by 75,000. Remember, we started, and we're putting here, we have an illustration that we're putting on the screen here so you can see. So basically, you start with $500,000. And your portfolio has declined by 75,000. So we have starting portfolio on my right. You have stocks 300,000, that's 60%. Bonds 175,000, that's 35%. And cash investments 25%. The cash investment can be money market account or just CD, certificate of deposit. So the total is $500,000. So the portfolio, the size of the portfolio, not the size, but the composition of the portfolio following the market correction is let's say the stocks, now you have stocks 225, so 53%, bonds are 175, 41%, and cash investments 25,000, 6%. So you have a portfolio whose value now is 425. At the same time, you need to withdraw 15,000 from your investment portfolio to cover an unexpected bill. For example, Uncle Tom or Aunt May is sick, or you have an important tax bill to take care of, so you want to withdraw $15,000. So to figure out what to sell in order to meet your cash needs, you should subtract your cash need from your current portfolio balance. So the current portfolio balance is what? 425. If you look at the screen, the cash need is 15,000. So the new portfolio balance is 410,000. Now, use your new portfolio balance and allocate and target allocation percentages to determine your target dollar amount for stocks, bonds, and cash investments. So to achieve your targeted asset allocation, you actually need to buy more stock. Remember, you were at 53%. You got to bring the percentage back to what? To 60%. So you need to buy more stock, presumably at lower prices, because the market has gone through a correction phase, right? So this should work in your favor should the market turn around. Think about that. Folks who back in March or April 2020 bought Tesla around 350 or 400, and I'm very happy to say I'm part of those. Imagine where they are right now, where the stock has more than tripled or quadrupled. So after selling overweight positions and buying underweight ones, you can use the remaining cash proceeds to pay your unexpected bill. So we have done the calculation for you here on the screen. So let's have the new portfolio balance. So you have 410,000, and the target allocation is 60% for stocks, 35% for bonds, and 5% for cash investment. So if you multiply 410 times 60%, that's 246,000. If you multiply it to 410 times 35% bonds, you have 143,500. And the for cash investments, the amount should be around 20,500. So you see the target amount, that's the ideal amount, minus the current amount. So current amount is 225 for stocks, 175,000 for bonds, and 25,000 for cash investments. So what is the change needed to reach your target amount? Remember, the target amount is 60, 35, and 5%. Or in dollars is 246, 143, 500, and 2,500. So for stocks, given the fact that the target amount is higher than the current amount, you need to buy 21,000 worth of stocks. For bonds, that's the opposite. You need to sell because the target amount is lower than the current amount. So you need to sell 31,500 worth of bonds. And for cash, your target amount should be 20,500, and you need to basically sell 4,500 to be able to, again, those cash investments can be money market accounts or CDs. So the delta here is 4,500. So you can see that the total change needed to reach your target amount is actually the money you need to take care of that unexpected bill. So 21,000 minus $31,500 minus 4,500 equal 15,000. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are here talking about 4 tips for selling in a down market. So the first tip is rebalance your portfolio, and I've actually walked you through the percent. I've walked you through a hypothetical 500,000 portfolio and what you can do with the 60, 35, and 5% for stock, bonds, and cash. Now let's talk about the second tip. Take out the trash. So once you have figured out which assets class to sell, it's time now to identify individual investments to offload, right? So this is the place where you have to start looking at your whole portfolio. You got to identify the weak prospects or those underlying securities that no longer match your goals. So if you wouldn't consider buying more of a particular investment today, then you should seriously consider selling it. Think about it. You bought stocks in a particular sector 6 months earlier or 9 months earlier. You were pretty upbeat about it. Now things have changed. The market has turned around. We've seen correction. We've seen a correction phase in certain industries. So you change your mind. It's normal. So you have to rebalance your portfolio. You need to get rid of certain sectors and maybe reconcentrate on other sectors. So to evaluate the merits of, say, an exchange traded fund or a mutual fund, you want to check that its investment strategy still matches your goals and its recent performance is in line with your expectations. Now, to evaluate the merits of an individual stock, You want to check out the underlying company's earnings and balance sheet for signs of weakness. You also want to read the latest SEC filings, the 10Ks, the 10K and the 10Q. You want to be very careful here, because please do not put emotions in this. It's not about being emotional. You have to be very rational here. Don't be sentimental. That's what experts say. Because even if a stock has performed well for you in the past, it doesn't mean it will continue to do so in the future. Remember that remember that disclaimer that the SEC wants fund managers to always put on their prospectuses. Past performance is not a sign of future performance. Simply because you made money in the past on a particular stock doesn't mean that stock will continue to make money for you. You have to move on. When the wind has turned around, you gotta follow the new wave, and that's what you have to think about. So you need to assess the merits of each underlying security using either, if you have if your broker has analysis tools, please use those analytical tools to evaluate the intrinsic value of each underlying stock or bond or mutual fund or ETF or money market account in your portfolio. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. If you enjoy the quality and clarity of the content so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we release this kind of shows every single day, rain or shine. Now, let me talk to you about the third tip. So I gave you the first two tips. We have take out the trash and rebalance your portfolio. Tip number 3, you want to harvest some losses. We've covered the topic of tax loss harvesting in another show, so I'm not going to go in depth here, but please just remember that if you need to sell more after offloading investments that no longer match your goals, it's time to realize some losses. Remember, selling at a loss is never easy, but sometimes it can actually work in your favor. That's because you can use those losses to offset gains you may have realized in your taxable accounts over the course of the year. And this strategy can help reduce your overall fiscal liability. And this strategy is called tax loss harvesting. Now, let me quickly get into that quickly. How do you use a tax loss to get a tax break? Let's say you realize $10,000 in short-term capital gains and $15,000 in capital losses. You can use tax loss harvesting to cut down your tax bill. By the way, for those who are rookies here, short-term capital gains means that you have actually bought a stock or bond and you have held the security for less than a year and you have made a profit on it. You haven't made the profit because the profit is still unrealized because you haven't sold the security yet. But short-term just means less than a year. So in financial parlance, short-term means the holding period is less than a year, and capital gain. So if you realized 10,000 in short-term capital gains, in other words, now you sold the underlying security, and 15,000 in capital losses, here is what you can see. Just look at the screen here. So we have short-term capital gains 10,000 and short-term capital losses 15,000. So you have $10,000 of capital losses used to offset 10,000 of capital gains. Then you have 3,000 of losses used to offset current ordinary income, and the extra 2,000 of losses used to offset future gains or ordinary income. So the taxes that could have been owed without tax loss harvesting is actually $4,160. And here is the math here. Imagine you are in the 32% tax bracket. So capital gains on the 10,000 that you realized, the 10,000 profit that you realized. So you have 3,200 times, you have 10,000 rather times 32. That's 3,200. So plus your ordinary income. So that's 960. In other words, the 3,000 of losses times 32. That is 960. So 3,200 plus 960 equal 4,160. That's the amount that's going into your pocket because you are smart enough to use tax loss harvesting. Remember that even if you have no gains to counteract, you can still use your losses to offset up to 3,000 of ordinary income per tax year until all of your losses have been accounted for. So remember that even if the proceeds from harvesting losses exceed your cash needs, you should reinvest the money in holdings that match your target asset allocation and show promising future prospects. One thing you want to make sure though, and this is very critical, folks, please be sure you don't violate the so-called wash sale rule by repurchasing the same or substantially identical securities within 30 days before or after a sale, lest your losses be disallowed. Tip number 4, be tax smart. Folks, when it comes to investment, it's all about being fiscally shrewd, right? You want to be intelligent here. You want to surround yourself with the best minds in the business. If you don't have a knack for investing or fiscal optimization yourself, please surround yourself with the best of the best if you can afford them. Be tax smart. If after harvesting all your losses, you still need to sell assets to meet your cash needs, and this happens depending upon your portfolio, depending upon your personal situation. It's all, and this kind of analysis, you have to look at it on a case-by-case basis. But you want to be sure at all times to make tax efficient choices. For example, think about selling investments you've held for more than a year so that you get taxed at the 15% maximum capital gain tax rate, because any gains on stock, bonds, and mutual funds held for more than a year are taxed at a maximum federal long-term capital gains tax of 15%. Sometimes it's 20%. Remember, the rules of capital gains taxes fluctuate all the time depending on the whims of congressmen and senators, our beloved congressmen and women and senators. Remember, so it goes from 15 to 20%. That's for long-term capital gains tax rate. Whereas investments held for a year or less are taxed at your federal ordinary income tax rate. This is why in the calculation we were doing earlier, I used the 32%, assuming that you were in the 32% tax bracket. So here on the screen here, I'm just showing you that you have a tax liability on 10,000 gain for a person in the 32% federal tax bracket is $3,200. So we have the short-term capital gains rates, 32%, and the long-term capital gains rate of 20%. Here we use the maximum rate, 20%. So you have 3,200 on one side and 2,000 on the other side. So when it comes to being fiscally smart, you got to plan ahead. You have to think about not only your tax situation, but also how the markets. You have to think about your risk appetite. You have to think about your fiscal appetite. In other words, you have to be tax. You have to optimize your portfolio in terms of taxes. You have to think about how the markets are moving, your personal goals, and all the steps I'm giving you, all the 4 steps I've given you. Those steps will be part of your regular portfolio maintenance, regardless of whether or not the market is going through a correction or not. So if the recent volatility exposed flaws in that routine, in your routine, now is a great time to do some proactive planning so you are better prepared for next time. Now remember, the market always, that's what markets do. Markets go up and down. Simply because the market is just going through a correction doesn't mean you should sell everything and go to Acapulco, although I would love that, but I would love being there myself. But you just have to be patient and be disciplined. So now is a great time, if you haven't already done so, to do some proactive planning so you are better prepared next time. One thing I want you to pay attention to is that you should remain vigilant about maintaining an asset allocation that's appropriate given your time frame and goals. Your time frame and goals. How old are you? What are your goals? And the asset allocation here again is what? 60 40 60 35 5 in terms of asset allocation, in terms of percentage of stocks, bonds, and cash. And as I was saying earlier, that's if you are between the ages of 20 to 45, 48. Past that, you want to reduce the proportion of of stocks in your portfolio, maybe bring it around, maybe flip things around. So go 60% bonds, 40% stocks, or 60 35 and 5, and 5 always being cash. You need to have cash. You need to maintain some liquidity in your portfolio. I don't care how smart you are, you need to maintain some liquidity. Things happen. Everybody needs cash from time to time. Now let's have a conversation about the allocation. What is the right allocation for you? How you allocate your assets should be based on three things. I said a few of them here. So your goals, both short and long term, the number of years you have to invest, and your tolerance for risk. That's what I call the risk appetite. Let's look at this beautiful infographics here prepared by our friends at Charles Schwab at the Schwab Center for Financial Research. Beautiful. So it shows us whether you are in the conservative, moderately conservative, moderately aggressive, and aggressive category. It depends. So the time frame, if you have a time frame of 3 to 5 years, so you are in the conservative. So your goals, this is appropriate for investors who want current income, investment stability, and capital preservation. So fixed income, that's bonds, cash, large cap stocks, international, and smallest cap stock. Moderately conservative, 5 years. So this is appropriate for investors who want current income and investment stability, but also some opportunities to grow their investments. So fixed income, again, you have bonds, 50%, large cap stocks, I'm talking about Apple, Microsoft of the world, Walmart, international 10% cash, small cap stocks 5%. 10 years. This is appropriate for investors who want current income, solid growth, and relative stability, and who can tolerate low levels of portfolio volatility. So large cap stocks 35% bonds, international 15%, 10% cash, and 5% cash. 10% small cap stocks. Remember, small cap stocks are more volatile than large cap stocks. If you have a moderately aggressive investment strategy, so that your asset allocation should be 45% large cap stocks, international 20%, fixed income 15%, 50%, the same percentage for small cap stocks, and cash 5%. This is appropriate for investors who are most concerned about growing their investments and who can tolerate moderate levels of portfolio volatility. And the last category, the aggressive category, is the time span here is 15 years or more. This is appropriate for investors who are most concerned about growing their investments and who can tolerate high levels of portfolio volatility. So you have large cap stocks 50%, small cap stocks 25%, international 20%, cash 5%, and no fixed income. This aggressive strategy is pretty good for young people. I would say people in their teens or young adults. These days they're called millennials, I believe. So this is pretty good for that category of people. Remember, the higher the risk, the higher the rewards. One thing I want to say is when we kind of look into the 5 categories of portfolio here in terms of allocation, what's really important to understand is that bonds, aka fixed income securities, provide some kind of cushion. They are less volatile. They also provide regular income, right? You have interest income, either 6 months or on an annual basis. This is called coupon income, because they usually pay a coupon rate, and so do stocks. Also, they do. Large cap stocks usually pay dividends, and that's also considered fixed income in some way. But my point here is that you have to understand that if you are on the conservative part of the spectrum, the conservative end of the spectrum, you want to reduce the level of the portion of stocks, especially small cap stocks. You can see here that on the screen here in the infographic, small cap stocks was 0% for the conservative type of risk profile, and on the other end of the spectrum, aggressive had 0% fixed income. So what I'm trying to say here is that the right portfolio allocation isn't just about your emotional tolerance for big price swings. It's also about your time horizon. The question is, can you afford to wait out a big loss? Remember, the market always comes back in the long run, but what long run means what? How long would it take? 5 years, 10 years? Can you afford to wait out that loss? Would you still be alive by the time the market comes back? Not really. So it's all about matching your risk strategy to your long-term goals. So this is why we are recommending here during this show that individuals who are nearing or in retirement have enough cash on hand to cover at least a year's worth of expenses plus another 2 to 4 years worth of cash in a relatively liquid investment like a certificate of deposit or short-term bond fund. So if you have enough short-term cash reserves stored up, you can avoid selling during a downturn altogether. Because remember, nobody wants to buy high and sell low. And with a little planning, you may never have to. All right, folks, this was it for today's conversation. I really appreciate your following us and being part of this conversation. I was talking to you about 4 tips for selling in a down market. Tips number 1, let's do a recap here. Rebalance your portfolio. Tip number 2, take out the trash. Tip number 3, harvest some losses. And tip number 4, be tax smart. I will see you next time. But until then, remember, stay marvelous.